Hello and welcome. We're just getting started. Thank you so much for your patience as we had some technical difficulties here. Let me get the presentation on the screen. Thank you so much. Thank you for joining. We had some technical difficulties, but we're ready to go now. So we've got some great content. We appreciate everyone taking the time to join. If you can't stick around, you can come back to our YouTube channel and you'll be able to access the recording. So today we want to talk about the certain element of the 2025 budget proposed by the Biden administration, following the State of the Union. And so as among many, of course, elements of that proposal, one is a reintroduction of the Mega Backdoor Roth ban. So since so many of our clients, of course, are interested in making Mega Backdoor Roth contributions, we want to, of course, keep the community up to date on this development. Please, please let me know if you can't hear me. Thank you so much here. So give you a second to verify. Can you hear me? Okay, awesome. Thank you so much. We wanted to give you an update on the development, and of course, please continue to stay tuned. So the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation when making an investment decision. Please consult with your tax attorney and financial professional. So first off, please subscribe, as we are in the middle of a number of deep dive webinars specifically focused on contributions. Right now, we're wrapping that batch up of webinars. There's a number of webinars, though, that are in the pipeline. So just to highlight one batch that's coming up would be how much income I need to be able to maximize contributions. That's going to be tailored for all the different business types, right? Whether you're an S Corp or a C Corp or a sole prop, such as a single member LLC, or a partnership, a multi-member LLC. So really put some meat on the bones as far as those contribution rules. So please subscribe and you'll get notifications. And of course, when there's updates regarding this topic, you would also get those updates as well. So let's put this in context, right? How did we get here? So Peter Thiel, as mentioned in some of the comments, right? There was a ProPublica report that came out in the summer of 2021 detailing how Peter Thiel grew his $2,000 Roth IRA contribution in 1999 into a Roth IRA worth $5 billion, right? So for those in Congress, at least some, I should say, there was a negative reaction to that report. And so part of these proposals could be viewed as a response to that report, right? The notion that there might be really high balance Roth retirement accounts that may never be subject to tax. So there was a proposal that came out first in September of 2021 as part of the Build Back Better Act from the Biden administration. And that proposal, and this is not something that was first introduced by the Biden administration. If you really go back in history, it came back a couple of administrations even before that. There was a similar type proposal around these types of accounts. But it went pretty far legislatively with the Build Back Better Act. That, as far as the elements of it, number one, there was a proposal to essentially create a new required minimum distribution for high income taxpayers that had a large retirement account balance. And then also, as part of that Build Back Better Act, there was a proposal to ban the Mega Backdoor Roth and the Backdoor Roth IRA contributions. Some of the ban applied to the high income taxpayers. Part of the ban applied to all taxpayers. Ultimately, though, it never came to fruition, right? I mean, there had been scuttlebutt in prior administrations. Nothing really came about of it. With the Build Back Better Act, legislatively, it went farther than it ever had gone before, but ultimately, the Senate at the end of 2021, they didn't pass the Build Back Better Act. So the Build Back Better Act got rebranded as the Inflation Reduction Act, but in August 2022, but it didn't include the proposed ban. Then in March 2023, similar to this year, as part of the proposed budget, it was included in the proposal, but that never gained traction and it never was implemented. So now we're in this year with the 2025 proposed budget, and there's another attempt to include it, right? So if you look at the the budget that came out this week, there's a proposed ban. So they've got both of the elements, right? We've seen this before. It's what was proposed back in 2021 in response to, again, the Peter Thiel ProPublica report. So you've got the new required minimum distribution for the large balance accounts for high income taxpayers. Then also the ban on being able to make the backdoor Roth IRA contributions for high income taxpayers, plus a general ban for the Mega Backdoor Roth strategy. And so if you look at the explanation that goes along with the proposal, as far as the policy rationale, the proposal aims to close the loopholes for the wealthy, including reforming tax-preferred retirement incentives to ensure that the ultra-wealthy cannot use these incentives to amass tax-free fortunes, right? And of course, from our perspective with our client base, right, this is not ultra wealthy individuals. These are, self-employed individuals that may not have had access to traditional retirement accounts. And so they may be playing catch up in terms of just securing their retirement security, in terms of being able to catch up and increase the amount of funds in their retirement account, right? They might have, uneven compensation or income, right? Because it's a business that they own, instead of having a W-2 job where they can make contributions every pay period, et cetera. So, of course, that is not understood as part of the rationale, but ultimately, from a practical political perspective, really just like with the prior proposal, when it was part of the 2024 budget, the initial response from the House Republicans has that this proposal is dead on arrival, with no chance of passing the Republican-controlled House. So let's dig a little deeper, though, and look exactly at the proposal. So really, it's we could have just repeated the slides from the 2024 proposal, but just to refresh and explain exactly what's in there. You've got, number one, back in the ban large retirement accounts for high income taxpayers. So first we got to understand, okay, who's a high income taxpayer, right? That's going to be someone who has over $450,000 in income if married filing jointly, $425,000 if the taxpayer is a head of household, or $400,000 in all other cases. So that's one element to be covered by the ban. The other element would be having a retirement account where you have over $10 million in value of that account. So it creates this new required minimum distribution where the individual is going to have to withdraw 50% of the excess over 10 million. And then if the value exceeds 20 million, there's going to be a floor that is set equal to the lesser of the excess or the portion of the taxpayer's aggregate vested account balance that is held in a Roth IRA or designated Roth account, right? So you could view this as the direct response to the Peter Thiel ProPublica report. This would become effective for tax years beginning after the end of this year. Also back in is the ban on Roth conversions for high income taxpayers, right? So it takes the same definition of who a high income taxpayer is. Looking at the language from the so-called Green Book, right, which is coming from the Treasury Department, which is a much fuller explanation of the proposal, right? It's hundreds and hundreds of pages, but looking at the section that applies specifically to these proposals, it appears that it's going to track what was proposed before, where it's going to prohibit pre-tax to Roth conversions. It's going to apply to both IRAs and 401k plans, and it would be effective for tax years beginning after December 31st, 2024. Okay, so element 3 of the proposal, again, back in, ban large retirement accounts for high income taxpayers. Oh, I think I went backward. Sorry about that. Sorry, that was the first one. So point 3, back in, ban the backdoor Roth IRA and Mega Backdoor Roth solo 401k. So just like last time, the proposal is not, so let's pause and just let's understand what a Mega Backdoor Roth solo 401k contribution is, right? Because it's really 2 steps, right? Step 1 is making a voluntary after-tax solo 401k contribution. Then step 2 is transferring those voluntary after-tax solo 401k funds either to a Roth solo 401k or a Roth IRA. So the proposal doesn't propose to ban the ability to make after-tax solo 401k contributions, right? It just bans the ability to then transfer those funds to either a Roth solo 401k or a Roth IRA. But of course, the reason that someone transfers the funds to a Roth solo 401k or Roth IRA is that then the subsequent growth is going to be potentially tax-free, potentially because ultimately you'd have to take qualified Roth distribution, whereas gains that accrue inside the voluntary after-tax solo 401k sub-account would be taxable. So if the ban was enacted, one could still make voluntary after-tax contributions to a 401k with the gains growing on a tax-deferred basis, but ultimately the gains would be taxable if you can't transfer them over to a Roth account. So what it is going to ban is going to be, again, being able to transfer those funds over to a Roth account. It's also going to ban the backdoor Roth IRA, right? This is where one makes a non-deductible IRA contribution because their income is too high and then transfer the funds over to a Roth IRA. Again, the language of the proposal is not limited to high income taxpayers, and this would become effective January 1 of next year. So let's put a pin in that, of that effective date. And then we're going to come back to that when we talk about some of the practical steps that someone might take if you were really concerned that this was going to be enacted, even though, again, the response, of course, from the House Republicans is that it's dead on arrival. Of course, we have to remember this is an election year. This is just the initial proposal, right, which happens after the State of the Union. These negotiations don't even start until the fall, right? They wouldn't even complete until after the election, right? So there's a number of variables just legislatively, electorally, right? We're waiting for the election results to come out. And then, of course, there could be other events, right? Unknown events that occur that could shift the legislative priorities, right? So, but if it were to, right? If it were to be enacted, what are some of the practical steps that one could take to be able to still be able to maximize these Mega Backdoor Roth solo 401k contributions? So number one, there's still time. If you don't have a solo 401k plan, there's still time to set up a plan during 2024 and make Mega Backdoor Roth solo 401k contributions for 2023. So can I still set up a plan in 2024 and make 2023 solo 401k contributions? In short, yes. So of course you have to be eligible to set up a plan, right? You have to be self-employed, meaning you're reporting earned self-employment income on your taxes, with no non-owner, non-spouse, full-time W-2 employees. And then you could set up a plan in 2024 and make 2023 contributions. So then the question becomes, okay, when is the deadline? Well, it varies based on how the self-employed business is taxed. So we're going to look at the three different variations, right? So of how your self-employed business is taxed to understand exactly when the deadline is. So let's first look at someone whose business is taxed as a sole proprietorship, right? It could be an independent contractor. You get a 1099 NEC. Or maybe you have an LLC, but it's a single member LLC. It's a disregarded entity, right? Ultimately, for all these scenarios, you're reporting that income on Schedule C of your 1040. So first row, okay, this is someone who actually set up the plan in 2023, right? We know that that individual has preserved the ability to make contributions for all types of contributions all the way up until their business tax return deadline, including any timely filed extension here in 2024. That's clear, right? Based on IRS publication 560. But again, we're talking about someone who didn't do that, right? So if you didn't set up the plan by the end of 2023, if you set up the plan here in 2024 and you did it by April 15th, well, you actually you can still make all types of contributions, whether it's employee, employer, or voluntary after tax by April 15th. But even if you don't do it by April 15th, if you file a timely extension for your business tax return, which of course for someone who reports their income on Schedule C of your 1040 is your business tax return. So if you file a timely extension for your 1040, now you have until October 15th. And the type of contributions that you could make by October 15th would be no longer the employee at that point, but you could still make employer, and specific to this conversation, voluntary after-tax contributions. So in short, if your business is taxed as a sole proprietorship, single member LLC, or independent contractor, where you're reporting that income on Schedule C of your 1040, and you didn't set up a plan by the end of 2023, if you file a timely extension for your 1040, you'll have until October 15th of this year to set up the plan, open the account, and make the voluntary after-tax contribution for 2023. So there's still time. Now let's talk about other types of self-employed businesses in terms of how those businesses are taxed, right? It could be a C Corp, an S Corp, an LLC taxed as an S Corp, right? So again, likewise, if you already set up the plan by the end of last year, in other words, you signed up with us by the end of 2023, you have until your business tax return deadline, including any timely filed extension, to make all types of contributions. So that would be March 15th or September 15th of this year. Now, if you didn't set up the plan by the end of last year, right, you could still set up a plan in 2024. Of course, here on March 15th, you'd need to file a timely extension. But if you file a timely extension for your business tax return deadline, so now say your S Corp deadline, right, then you'll have until September 16th to make both employer and voluntary after-tax contributions for 2023. So again, specific to this conversation, you can still make those after-tax contributions for 2023 and then transfer those funds over to a Roth solo 401k. So you can still make the 2023 Mega Backdoor Roth solo 401k contributions. And then for a business that is taxed as a partnership, it's going to be the same deadline, right? So if you file a timely extension for your 1065, your partnership tax return, now you'll preserve the ability to make those 2023 contributions as long as you sign up, open the account, and then you can make not employee, but you can still make employer. And again, specific to this conversation, the voluntary after-tax contributions. So in short, for all types, there's still time to be able to make those 2023 Mega Backdoor Roth Solo 401k contributions. Just note, if your business is taxed as an S or a partnership, at this point, of course, on March 15th, you're going to have to file a timely extension to be able to preserve the ability to set up a plan, make those after-tax contributions for 2023. Now, what about 2024? Well, of course, there's in the absence of this proposal, right, there's plenty of time to set up a plan and make 2024 contributions, right? It can be done anytime this year, and you preserve the ability to make contributions until next year, right? That's the general rule. But what happens if this ban is indeed enacted, right? Which again, we're not going to really have total certainty, even though the House Republicans have said it's dead on arrival, even though it's an election season. There's so many variables that are still unknown that would prevent this from being enacted. It's not going to be for certain until, after the election, after the negotiation of the budget in the fall, et cetera. So if it were to be enacted in its current form, remember I said to keep in mind that the Mega Backdoor Roth ban would become effective on January 1st. And remember what I said, how really making Mega Backdoor Roth contributions is a two-step process. And what's proposed to be banned is not the first step of making contributions, but the subsequent second step of transferring those funds over to a Roth, solo 401k, or Roth IRA. So if the ban's enacted, that means that the individual would have to make the contributions and then move the funds over to either a Roth solo 401k or Roth IRA by the end of the year. So if you don't have a plan, right, you would need to open one, assuming you're eligible, make those after-tax contributions, and then move the funds over to either a Roth solo 401k or Roth IRA by the end of the year. And that would then you would be certain, right, that even if the ban was enacted, you got those contributions in for 2023, you got those contributions in for 2024. So that would be the practical step you could take if you were concerned that this was going to be enacted. So we're going to have time for Q&A at the end. We got some bonus content just to highlight our plan. We get beginning a number of questions about this, and we want to make sure we get a chance to address those as well. That our plan now qualifies for a $1,500 tax credit. So under the Secure Act, which was enacted at the end of 2022, there was a number of tax credits that were authorized to really encourage small businesses to set up a 401k plan. And so some of those tax credits don't apply, of course. For example, the startup cost credit is not going to apply to a solo 401k because in order to be eligible to claim a startup cost credit, in other words, to recoup some of the costs to set up the plan, that would only apply to a business that has non-owner employees participating in the plan. And of course, in order to be eligible to set up a solo 401k plan, the business can't have any non-owner, non-spouse, full-time W-2 employees. But there's another section of the code that was authorized, another credit that was authorized, which is called the automatic participation or automatic contribution, automatic enrollment credit. It's all the same credit, which is a $1,500 credit. The way that it works is it's $500 per year for 3 consecutive years. Both new plans as well as even existing plans can be upgraded to include the automatic participation feature so that now even those existing plans would be eligible for the credit. And unlike the startup cost credit, it's not a function of the cost to set up the plan. So even if the costs are less than $1,500, like is the case with our plans, the self-employed business can still claim the full $1,500 in credits. So if you signed up for a new plan here in 2024, the individual would be able to claim a $500 credit when they file their 2024 taxes, and then again for 2 more years, as long as they maintain the plan with the automatic participation feature. If you already have an existing solo 401k plan, let's say you have a basic plan, say like a brokerage like Vanguard or Fidelity or Schwab, and you want to upgrade your plan, it could be because you want to take advantage of the ability to make Mega Backdoor Roth solo 401k contributions. Well, now on top of that, the plan is going to be eligible for a tax credit. $500 per year for 3 consecutive years. So if you were to upgrade to our plan, for example, in 2024, you'd be able to claim the credit when you file your taxes next year, and then again for 2 more years. So you can see with this chart, it shows really the impact to the cost, right? We charge $650, which includes the $525 establishment fee plus the first $125 annual fee. So your net cost for the first year is $150. For the following 2 years, so on the anniversary date, we charge our $125 annual fee, which covers the second year. So there, clearly, that's much less than the value of the credit, but the individual would still be able to claim the full credit because it's not a function of the costs, right? So for second and third year, the value of the credit is significantly greater than the cost. And it is a tax credit, not a tax deduction. So a tax deduction reduces the income upon which your tax liability is calculated. Whereas with a tax credit, you first determine your tax liability, and then you're able to reduce your tax liability dollar for dollar by the value of the credit. So in that way, it's much more valuable than a tax deduction. So in order to be eligible, you have to be eligible to set up a plan, and then set up a plan like our plan that includes the auto contribution feature. The auto contribution feature sets a default 3% contribution percentage, but under the terms of that feature, the employee, so in this case, the solo 401k owner, has to be given the option to opt out, right? And so it's going to be an update to the plan. There's notices that have to be prepared. You have to have the opt-out form provided. So of course, we provide all of those extra documents as part of the plan documents that we prepare. And then the solo 401k owner can opt out of the default percentage. That doesn't mean that the individual can't make contributions. It just means that they preserve the ability to make contributions in whichever amount or schedule or interval that they prefer, of course, subject to those contribution limits and the deadlines. And technically, you're not even required to make contributions to qualify for the credit because you'd still have the auto participation feature in the plan. Again, if you have, say, a basic plan at a discount brokerage, the plan could be upgraded to include the feature so that the business owner would now be eligible for the credit. You claim the credit by filing Form 8881, which is really the first step in the process of claiming the credit. We have a deep dive webinar, really a series based on all the different business types that really walks the individual through all those required steps so that you know exactly what you need to file and how to complete the forms to be able to claim the credit and reap the benefits. So, for example, Lindsay is self-employed. She has a solo 401k plan. She amends her plan to add the auto contribution feature. If she does that in 2024, then she'll be able to claim a $500 tax credit for 2024, and then again for 2 more years, as long as she continues to maintain the plan with the auto contribution feature. Whereas Brad doesn't have a solo 401k, but he's eligible to set up one because he's a solo practicing attorney, no employees, working for any business owned by him or a spouse, if any. If he signs up in 2024, he would be eligible to start claiming the credit when he files his 2024 taxes, and then again for 2 more years for a total of $1,500, as long as he continues to maintain the plan with the auto contribution feature. I also want to highlight our resources. For example, we have daily Zooms on our community, mysolo401k.net/my community. We have forums where people are posting questions 24/7. We have a deep library of videos and webinars, hundreds of videos and webinars. So it's, of course, free to join. All are welcome. It's just a great way to learn, to share the knowledge, to hear what other people are asking about. And then, of course, just to highlight, this is a series of, we've got a series of webinars coming up on YouTube. So if you subscribe on YouTube, you get notifications of all that great content. Again, we're in the middle of our series of contribution webinars. So stay tuned and you can just get access to all the good information. So thank you so much for all the great participation. Hopefully this has been helpful. I'm not sure with the question. I must have missed that one. So I have a solo 401k with you, which requires opening a C Corp. Can change to S Corp to avoid preparing 2 taxes since S Corp is passed through. So you don't need to have, I'm not quite 100% on the question. Thank you so much for bringing it. You don't need to have a C corporation in order to have a solo 401k. If you have a 401k business financing plan or ROBS, which is really a totally different type of plan, you do need to have a C Corp, right? But for a solo 401k, the individual just needs to be self-employed, reporting earned self-employment income, no full-time employees working for any business owned by the individual or spouse, if any, they can operate their self-employed business as a sole prop, as an S corp, or as a C corp, etc. So as far as if you change from, say, a C to an S, what that would mean in terms of your business tax filings, that's of course something to address with your tax advisor, right? It's not a 401k question, but it's not going to prevent you from having a solo 401k. So hopefully that helps. No, please, if you are our existing client, please just contact us and we'll give you access to it. Thank you so much. I set up a plan with you guys in 20. Can I still make, if your business is taxed as a sole proprietorship, like a disregarded entity where you report on Schedule C, then if you set up the plan by the end of 2023, you're going to have until your business tax return deadline, so your 1040 deadline, including any timely filed extension, to make all types of contributions, whether employee, employer, voluntary after tax. And if you file an extension, in other words, for your 1040, now you have until October to make those contributions. It's very simple. You can, for example, you could just Google S Corporation extension. So you got the 1120S. You filed the form. To get that form off the IRS website, or if you have your like a tax advisor, they're probably very busy today getting those done. But they still may be able to accommodate. To summarize, if the proposals went through, and thank you for that good question. If the proposals went through, anyone, any income could still do after-tax contributions to a solo 401k, right? The contributions has not been proposed to be banned. It wasn't before, and it doesn't appear to be in this case. Well, the growth would be tax deferred, but ultimately when you took a distribution, it would be taxable. Anyone, any income could not convert after-tax 401k to Roth solo 401k or Roth IRA. Yes. Let's go back to the chart there. Just trying to align it. Make sure I'm not missing your question. Well, they're also trying to ban the high income taxpayers from processing a pre-tax to Roth conversion. The backdoor Roth IRA would be banned for everybody under the language of the proposal. I mean, admittedly, it's not a formal legislative proposal, right? It's more of a summary. So sometimes there's vague language, but I would say it would be safe to assume it's going to be just like last time. Hopefully that helps. Yes, if you signed up in January of 2024, then your plan would include the auto participation feature, and you would know because there would be the notice in there regarding the feature. There's going to be the summary plan description. There's going to be the deferral election form that allows you to opt out, etc. So if it's a Rob's business financing plan, changing to an S corp there's a number of considerations, right? I mean, you can no longer you cannot change to an S corp if you still own part of your business through your Rob's 401k. So typically, what folks do is they would have the corporation buy back the stock from the 401k, and if all the stock is bought back, there's no stock owned through the 401k anymore, then the entity could elect to be taxed as an S corp. Hopefully that helps. To roll over after tax to Roth and Fidelity with your setup, do I simply do a regular transfer from the after tax account to the Roth account? Good question. So I'm going to pull up our procedure page. I'm assuming you're talking about the going from an after tax solo 401k to a Roth solo 401k, because we have specific pages and guides on each and specific to Fidelity. Let me chat that over in the chat here. Please take a look at that, that link. Thank you. If the legislation passes, what would be a better avenue for investment? After tax versus regular brokerage account with long-term capital gains? That's a very good question. It's going to depend on your circumstances. And so there's not going to be a one-size-fits-all solution. So it would definitely be something to review with your tax advisor. Thank you so much for all the good participation. We certainly appreciate it. Please continue to participate. Like I said, if you subscribe, you're going to get notifications. You can come to the community, of course, all are welcome. It's free to join. We'll give it another minute to see if there's any more questions. But yeah, we do appreciate everyone coming on short notice. And please continue to engage. We'll do our best to keep you updated on a real-time basis. All right, everyone. Well, thank you so much. Until next time, take care now.